Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview of the market, so every other week, where we look at the key events and trading opportunities that we see in the market. Whilst I just let you have a look at the disclaimer, I'll just run through the key objectives of the webinar. We think markets are primarily driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is generally to break down all the market jargon and complexities that we all read about. So if you do have any questions, please do ask them along the way in the box, and I'll hope to answer them as soon as possible, or at least after the webinar finishes. Okay, it's Wednesday, December the 7th, just after 11 a.m. in London. So let's get to it. We'll firstly look at just a run through of markets generally this week, how they're setting up. We'll look at Brent crude, which is grabbing the headlines, falling to year-to-date lows today. So we'll look at a quick technical look at the chart there on Brent weekly and the daily. Also then touch upon the DXY, the dollar index, and also the yield curve, which we talked about a couple of weeks ago. And then just look at stocks generally in the US, the indices there, and on a technical basis as well. We'll then quickly review a couple of last week's major data points as well as Powell's speech. We've got a couple of charts to look at on the inflation side of things, and then we'll touch on Eurozone inflation, look at euro dollar, before then wrapping up with the RBA, hopefully a recap of that and a preview of the Bank of Canada's meeting today. So a lot to get through. Firstly, we'll just go through what's happening with markets currently. I'll pull up the Brent crude weekly chart, as I mentioned, but markets really, they're preparing for the last key events of the year. So the policy meetings by the Fed, the ECB, and the Bank of England all meet next week, Wednesday and Thursday next week. And we also get actually the latest US inflation data. That is next Tuesday. So I think within sort of 48 hours or so, you have probably 4 major risk events happening, which really will give us some direction for markets into the new year. Of course, this comes after the strong US November payrolls data and the especially strong earnings growth that we saw on Friday. For this week anyway, global risk sentiment, well, before this week actually, I should say, global risk sentiment had been on a pretty even keel after the recent rally. But really then this week, it's interesting that fears around inflation and the Fed slightly in the background, whereas fears of recession and this 2023 global slowdown have really gained more prominence. And that's led to selling in stock markets, of course, risk markets, risk off, if you like, and a bid in the dollar, sort of safe haven bid that is really. And these all are sort of trumping those lifting in COVID restrictions that we've seen in China. That was kind of last week's story and gave a bid to stocks. But now, even with some of the new measures introduced overnight, markets are kind of looking beyond that, and those measures really failed to buoy sentiment too much. I see US futures are really still in the red, slightly in the red. S&P 500 down 0.27% or so, NASDAQ down 0.36%, and the Dow down 0.18%. Those are the US futures indicating a lower open again, just marginally so. As I mentioned, commodities, especially Brent crude, they're grabbing the headlines at the moment. Brent crude dipping below $80 and to year-to-date lows. This is despite the OPEC plus supply cut and expectations of falling Russian supply. And really all to do with concerns around this economic slowdown hurting the demand outlook for crude. The newly introduced G7 oil price cap has done really so far little to support prices. Even Russia said yesterday it's considering a price floor or maximum discounts to benchmark that its oil can be sold at. Not too much detail on that, but for the time being, it's yes, the growth outlook which is dominating oil markets. Oil kind of responding to both good and bad US data at present. So positive data has caused oil selling through being good for the dollar and bad for risk assets, while negative US economic data, that's causing oil to be sold as recessionary fears increase. And that's really sort of hitting markets today. They're down again 1% or so. We can see Brent crude down 1.3% or so. And on the weekly chart, just looking at that really, just to show this break of a couple of key levels really. We've got the October 2021 high at where are we at 85.79. We broke, sort of consolidated around there and around the September low at 82.46, which looked like support, but then you can see this week we've broken quite sharply lower. So be really important to see the close on Friday, whether we keep below that 82.46 level. This grey line here is the 100-week moving average. That's at 84.60. So sort of support zone here, but potentially resistance zone if we close below there. That's the 200-week moving average way below here. But then if we go to the daily, this is Brent crude daily. You can see that break lower. Potentially, as I say, if the close is below here, below $82 or so, then we're looking at prices sub 80 going into the new year. You can just see on that RSI was slightly oversold, really getting below 30, but certainly you can see when it has got below there, then we've sort of moved or near there actually in recent months. Then we've sort of stabilized slightly. Let's just pull it back a touch. Yeah, you can see again, this was sort of below 30 again, and then we sort of stabilized and actually moved higher. So interesting to see whether we do stay below this key resistance support zone, sort of around 82.46 and above. That's Brent crude. Just going back, actually, last week I said we'd mentioned about the yield curve inversion, that being one of really the best mainstream market indicators of economic bearishness. And in fact, so the yield curve, why is it a good mainstream indicator? Because previous times it's preceded every US recession for the past half century. And it typically indicates that investors think high interest rates will crimp economic growth. Certainly, there are caveats to that. As I think we mentioned, the variance is quite large. The recession could actually be up to 2 years away, and there are sometimes false positives. But for now, it's again grabbing attention because the two most widely watched yields, that's the Treasury 2-year yield and the widely watched, of course, proxy for borrowing, that's the 10-year yield. That's now stretched that difference between those two yields to 82 basis points, and that is the widest level in some 40 years, and certainly since 1978 and 1982 actually. So lots of concern around that, and obviously there's potential for recession next year sometime. Just going back to that 40-year period, or 40 years ago, sorry, that period was when the Fed chair at the time, Volcker, he hiked rates aggressively to counter double-digit inflation. So it sounds very familiar. And that succeeded actually in bringing inflation under control, but the price paid was 2 long-lasting recessions. So just a pointer to where the market theme is currently. What does this mean for the dollar? Well, historically, it suggests that it doesn't fare well in the early stages of US recessions, but notably, of course, the Fed is yet to cave in at the moment. So that could be slightly positive for the dollar and then negative for commodity and pro-cyclical currencies. We'll just pull up the DXY chart actually, so we can see that. Just before that, we've also mentioned positioning in the dollar Long positioning certainly had driven this strong uptrend for most of this year, or at least until sort of September, late September, early October time. Probably the most favored position on Wall Street, certainly in the city, was being long dollars. That long positioning is now pretty much completely faded. The aggregate positioning of the dollar against its G10 peers is now neutral. There was a slight short actually. I think very small short last week, but really we're at the lowest levels now for over 18 months, I think, or so. That means there's more limited room for position squaring effects to weigh on the dollar. And obviously that is what we've seen slightly this week, obviously together with that safe haven bid. For the DXY then, we can see we found support at the August low at 104.63. Remember, the DXY is a basket of currencies, weighted basket of 6 major currencies, euro being by far the biggest weighting in the DXY, 56-57% or so of the DXY index. The chart, if we turn it upside down, would be the euro dollar chart, and we'll look at that shortly. But support at the moment on the DXY around that August low at 104.63, but then capping the upside. You can see the support there. Let's blow it up a touch. You can see then potential upside is being capped at the 200-day moving average. That's at 105.78, and then also we've got this June high at 105.67 as well. So interesting. If we can break above here, then we get towards sort of November, sort of the bigger range there. And we've got this 21-day moving average, so a shorter indicator, if you like, at 106.46, potentially if we can break above the 200-day moving average. Just looking at US equities then, they rolled over overnight. The S&P crossed back below the pivotal 4,000 level, completing really the rejection of last week's rally attempt. Sell-off led by tech. Cyclicals underperforming, especially growth ones. Really, it was concerns around advertising that sort of surfaced. There was a Wall Street Journal article reporting that Meta, so Facebook's parent, if you like, its targeted ad model faces restrictions in Europe. And Reuters then reported that potentially the tech company Meta could face quite large fines for this. The stock closed down nearly 7%, 6.79%, I think, lower on the day yesterday. And then also we had the energy sector being dragged down, of course, by lower crude prices. That was actually the biggest laggard and pulled the S&P down below 4,000. So technically we can see trend line resistance. You can see that dotted line from the highs in early January, quite a nice trend line because it touches a couple of points there, 3 points actually. So we should think that is a pretty strong trend line resistance therefore. And then also you've got the 200-day moving average at 4,042 cap resistance in August. Not so much, of course, before that, but always a widely watched indicator. And again, that's worked along with this trend line resistance. So we've moved lower from there. We might find support that you could see. That's the grey line. We should probably take out we'll leave in the shorter time frame one, the 21-day moving average. But we've got support here on this line, which is the 100-day moving average at 39.64. May hold up prices. It did so in the middle of last month. You can see we pushed above that, so it'll be interesting to see whether that holds. Otherwise then you've got the halfway point of this August rally at 39.08, so just below here, acting as possible support. But if we do lose that, then potentially we go lower towards sort of 3,800 or so. 38.23 is the 50-day moving average offering support. If we just look at the NASDAQ, Of course, we haven't got as high as that 200-day moving average, 100-day moving average capping prices there at 11,974. This is for the NASDAQ 100. So potentially if we go lower, we've got the 50-day moving average 11,367, and then potentially sort of a minor fib level around 11,200, just above there. But we're sort of back in this range, probably waiting to see what the Fed does. If we just show you the Dow, really interesting chart because we failed at the August highs at 34,281. Looks like we've rolled over there. Not finding much support from the 21-day moving average. So potentially then next support is that mid-November low at 30, where are we? 33,239, potentially acting as support. You kind of think, and I think we might have said this before a couple of weeks ago, to get that bigger leg higher in the Dow, we probably needed to see tech leading the way because that has been the laggard. And we can see that potentially that has rolled over, although we're back in this range. So sort of 11,367, 11,974, 12,000, sort of that top side and support level in the range for the NASDAQ and the Dow as well, then potentially 34,281 capping the upside there. But much will depend for sure on the US CPI data next Tuesday, and then obviously the Fed the following day. Okay, we'll just go into a couple of things from last week. First of all, the non-farm payroll data that we got on Friday. We saw strong job creation, a big increase in wages, underscoring really the Fed's argument that more work needs to be done. We'll get to that actually after the PCE data, but more work needs to be done to get inflation under control. It's interesting that, especially with these recessionary fears lingering, their market participants kind of remaining slightly skeptical over how long we can see this strong performance in the US jobs market. We can see, yeah, the beat, 8 straight beat in the headline. The 0.6% was wage growth month on month, smashing that estimate of 0.3%, and the annual number as well, smashed forecasts of 4.6%, I think, above 5%, 5.1% for the annual average hourly earnings, and that meant unemployment stayed where it was in October, 3.7%, very near 50-year lows of 3.5%. And interesting that the participation rate that's edged slightly lower, so that really indicates just this growing labour shortage still, and that's reflected then in those higher wages. Employment gains then broad-based really across sectors, pretty strong report really, although there was some analysts, economists highlighting the weaker household survey. That's normally less important, but that showed slightly less jobs growth, I think. And I think it's worth highlighting really the market reaction, really interesting as well, especially with the Powell speech, which we'll get onto from last week. But the market reaction after the non-farm payroll, big beat, decent prior revisions. In fact, came in at 2.9 standard deviations above consensus. So that was the largest beat since July's numbers. And then we did have that initial strong reaction, probably triggered by algos, but then the day-over-day response was pretty mild, really mild actually, considering the strength in the report. The change in yields, in bond treasury yields in the 2-year, which maps the Fed funds rate, and also the change in the S&P futures really was only half which would be expected. While the 10-year Treasury move and the broad dollar index, they declined actually on the day. So really interesting response, kind of in contrast to how the dollar especially responded to the soft CPI, which is roughly 5 times recent norms. And even misses in minor data like last month's PPI, which would normally be shrugged off by markets, that had a much more material impact than the non-farm payroll. Kind of interesting that we've obviously seen the sell-off in stocks this week, and people sort of highlighting the delayed reaction in a way to the strong non-farm payroll report. But we also had actually a Fed whisperer, Nick Timiraos, over the weekend, citing issues around high inflation still being an issue for the Fed, and then wanting to act on it. So a couple of things really about the reaction to non-farms. So really interesting. We also had last week the Fed Chair Powell's speech. He repeated his comments really from the November Fed meeting, and kind of in line with other speakers that we've seen over the course of the last few weeks. It makes sense to moderate the pace of interest rate hikes, and the time to moderate the pace of those hikes may come as soon as December. So that means that this 50 basis point hike, instead of a fifth consecutive 75 basis point hike, it would be actually. And he added, it seems likely that rates must ultimately go somewhat higher than what was thought in the September Fed dot plot projections. That peak was at 4.6% in September for next year. So certainly it'd be really interesting to see the dot plot obviously next week in the FOMC projections. Should say as well, said that the Fed have made substantial progress towards sufficiently restrictive policy, but there is more ground to cover, and he does say this consistently and also quite often about just being more work to do. He did emphasize then the length of time that monetary policy will be kept at or in restricted territory, and that is more important than the near-term incremental pace of hikes. So the question in a way is, does this slower pace of rate hikes actually extend the cycle further into next year? And again, interesting market reaction. Economists kind of took Powell's comments to be hawkish, but the market's really focused on the fact that there wasn't a specific pushback against the market pricing of rate cuts in, well, next year, but especially 2024, and the markets were fearing that. Also, the rhetoric previously used in the context of the risk of not tightening enough was now seen in the context of the risk of over tightening. So really the markets latched onto that. Financial conditions eased quite considerably actually after the speech. So what does that mean? I know a lot of economists are talking about financial conditions easing. Well, equities rallied, bond yields declined, real rates, they fell sharply as well, and then the dollar weakened. And really, this is important to highlight actually, but an easing of these conditions actually adds to the Fed's problems, as it's really kind of undoing the tightening effects of the Fed's recent rate rises. And that is kind of the complete opposite of what the Fed is trying to achieve by hiking rates. So really interesting to see whether the Fed Chair Powell in his press conference as well pushes back on this and says again, I've probably said it for 3 times, but there is still more work to do. And I know a lot of Wall Street are focusing on this potentially as being why we're seeing this bid in the dollar this week, along with obviously slightly risk-off sentiment, but that is being driven by the fact that the Fed may be slightly more hawkish than what the markets have been hoping for. We've also had actually latest consumer spending numbers together with anecdotal evidence of the Black Friday weekend sales. They show that the economy has not yet met the Fed's requirement of slowing to a rate well below its longer run trend. Just 2 other bits of data actually to highlight from last week. We had the Fed's favored inflation gauge, the October PCE data. That was softer than expected for the core month-on-month, while the year-on-year level of 5% was as expected. We also had ISM manufacturing. That's a gauge of US manufacturing outlook, and that fell actually more than expected. The main index fell below 50, so into contractionary territory, 50 being that threshold. And some of the details in that report actually were quite interesting, with new orders dropping, prices paid actually plunging, and the employment indicator also nudging lower. So some internals in there that the market took note of. We then had that core PCE data lower than expected. And really, when we look at it overall then, or looking at the Fed's favored measure of the trimmed mean, so the trim mean means that excludes the greatest outliers and takes the average of the rest. So inflation is ticking down slightly from the previous month, and also, well, both on a year-on-year and month-on-month basis. Certainly there's a long way to go. We're still elevated. We're still way above the Fed's target of 2%. But it's important that some of these measures, that stripped down measure and then the core PCE, are no longer accelerating for sure, and potentially moving lower. Just a couple of charts to show you that we've sort of picked up on. This one from ING, actually, investment bank, shows the proportion of companies looking to raise their prices over the next 3 months has dropped sharply very recently, and presumably reflecting some of this evidence of softening demand. And we can see really that relationship between, so the Fed's favored inflation gauge, that core PCE deflator, which is the grey line, still elevated, but then this corporate sort of price plans, an idea that corporates won't be raising prices as much as we think. That's dropped sharply, as we say, so potentially then that core PCE deflator will follow that in line and move sharply lower. And certainly then if we get softer data and then the economy falls into recession, then again that corporate pricing power story will weaken, and then also potentially bring that core PC deflator quite sharply lower and quite quickly. So interesting chart there. Also, one other chart, this is gasoline chart, which is probably the single most important outlier in some of the inflation data. Gasoline, we can see, well, it's fallen from those highs above $5, sort of early part of summer, right down below $3.50 now, below the level actually from just before the Ukraine conflict kicked off, actually. So encouraging signs there for headline inflation as well, potentially, and it also then increases pressure on other prices by releasing money from household budgets to be spent on other sectors of the economy potentially. So interesting couple of charts, we think, pointing to lower prices potentially going forward. Still elevated, of course, and still way above the Fed's target, as we've just talked about. Okay, we'll just look at, also we mentioned, Eurozone CPI data, or HICP data, is called in the US. So let me just pull up Euro-dollar chart for our guide that you can see here. But the Eurozone flash CPI saw inflation actually decelerate to 10%, still in double digits, but decelerating to 10% in November. Expectations were of a moderation to 10.4%. Energy inflation, the most important driver of the decline, while food inflation continues to trend up, actually. But if we just step away from the sort of headline grabbing drop to that 10%, the most relevant measure really is the core measure of inflation, and that didn't budge, actually. That remains painfully high at 5.5% year over year. That was actually in line with consensus, but really the ECB, European Central Bank, has shifted their focus of the policy debate to underlying inflation, to this core measure, because of its persistence, and really wary that, of course, the more volatile headline can lead to false dawns, in fact. Sorry about that. Yes, so Potentially interesting going forward. We're obviously getting colder weather, so if we get another episode in the energy crisis, higher energy prices, that could easily push inflation back up again. And core inflation, we note, usually tends to adjust slowly to energy shocks. So there probably will be more focus on the monthly data going forward. Food inflation, that's a big contributor here, while a lot of the higher costs have yet been priced through to the consumer. So all in all, that CPI data, the inflation data in Europe, kind of strengthens the case for just a 50 basis point rate rise in December at the ECB meeting next week. That's after, of course, a series of 75 basis point hikes in the previous meetings. The market kind of had leaned towards this anyway in wake of the country readings from the individual countries actually at the start of last week as well. But it's whether then the ECB therefore moves to a 50 basis point rate rise in December next week, but then signals if it's not done with raising rates, as it's kind of widely accepted at the moment that the bank kind of wants to move into restricted territory, really to push this inflation figures much lower towards target. But certainly the softer report we saw last week has kind of taken the edge probably off that larger 75 basis point hike for next week. Just looking at this week, not much on the calendar really, a few ECB speakers, but really it might well be sort of energy related news that is the driver. As I said, falling temperatures now in Europe. Also this price cap on Russian oil coming to effect, potentially having an impact on the single currency. Interesting that there's been, of course, relative strength in European stocks over US market returns over the last few weeks. DAX especially risen over 20% since its lows from October. So contrasting, say, with the S&P 500. And that's all provided a solid background support for the euro. So interesting then if we do get falls in some of the markets there, whether that is another cause for the euro to be more volatile, shall we say. Technically, the weekly close here, you can see above 105.17. That's a 50% retracement of the 2022 decline. That close, we did close just above that, so that looks good, or looked good for more euro gains, potentially to carve out sort of a higher range towards 106.50, 107 or so. But we've just sort of pulled around that level. You can see 105. 14 I had actually for the 50% retracement level of the 2022 fall. So we're sort of just oscillating around there, which is kind of not unexpected, pretty key level really. But upside, well, buyers will look towards 105.94, last week's high, whether that is a corrective peak or not. And then below here, we definitely have strong support around, well, 103.68, which is the August high. And then we've got the 200-day moving average, 103.64, as well as then a nearer term 21-day moving average, 103.55, I think. So strong, very strong support around here. But that would mean we go back into that sort of range from November. Upside level, as I say, 105.95, potentially being a corrective peak, some are saying, or if we do break higher, then we're looking above 106, and this sort of June high here, 106.06 as well, being a marker and potential level of resistance going forward for euro dollar. Okay, just now we'll just look at also this week's central banks, and we had the RBA yesterday. They raised its policy rate by 25 basis points to 3.1%, pretty much as expected. That brings a cumulative amount of tightening to 3% since the start of the cycle in May. The central bank expects to increase the interest rates further over the period ahead, but said it is not on a preset course. Remember that the RBA meets every month. I think that's sometimes disregarded, but really key point, RBA meeting every month as opposed to the Fed, the ECB, Bank of England, who meet more or less frequently than that, every 6 to 8 weeks, even 6 to 7 weeks really for those other central banks, but the RBA meets every month. So really they've said, yep, they're not on a preset course. They can be very data dependent because they meet more often. But inflation at 6.9% in October really is still way too high. And it's forecast actually to peak around 8% over the December quarter, although then is expected to decline next year. The economy as well, that continues to grow solidly, but again is expected to slow to about 1.5% in 2023 and 2024. Unemployment rate, that has to be noted, is the lowest since 1974 at 3.4%. So tight labour market pretty much everywhere, but especially in Australia as well. But all that said, with quite a lot of tightening already done, then the RBA potentially has indicated that monetary policy also operates with a lag, and that the effect of interest rate increases is yet to be felt. So interesting, really, quite a few central banks saying that and waiting for these effects, waiting to see those come through in data, and potentially then, as we said, being very data dependent. And that's why we highlight and focus so much on some of the key data points, of course. For the RBA, then, it seems that kind of the path to achieving the needed decline in inflation, achieving a soft landing for the economy remains quite a narrow one, actually. So we'll see going forward, as I say, quite frequent central bank meetings for the RBA, January next time, of course. But for the Aussie dollar, obviously global risk sentiment is a key driver of this, and China as well. But as we've said at the start of the webinar, kind of the China reopening story being trumped by fears over the slowdown for next year. So the Aussie dollar kind of, well, clinging on to support actually from July. That July support is at 66.81. We've also got a couple of moving averages, sorry, the 100-day moving average and the 21-day really crossing over there, but around that level as well, 66.81. So we're just hanging on to that support. Of course, we had moved up around 10% from the October lows on those hopes of commodity demand from the China reopening, but we've just pulled back from those highs. So resistance, you can see, is around sort of 66.45, 50 or so. Then resistance level above sort of 68, really, if you can see there from the November highs as well. So that will act as resistance, and then if we do drop below 66.81 for sure, then near term we have 66.40 and then 65.84 as support levels for the Aussie dollar. Finally, then we have the Bank of Canada. Today, consensus expects the bank to lift its overnight rate by 50 basis points. It's a statement only meeting, so no press conference, but it's really a very close call. Many analysts looking for just a smaller quarter point move. Actually, I think there's a Reuters poll, 16 out of 29 maybe, 16 out of 28 analysts we're looking at a smaller quarter point move, but markets are pricing in around a 64% chance of that bigger 50% rate hike. We've seen in Canada resilient economic growth, high inflation, kind of tilting the bias towards that bigger rate rise. CPI, October CPI held just below 7%, with price pressures still broad-based. Remember, that is over 3 times the target for the Bank of Canada, their inflation target. And also we had recent Q3 GDP data that came in double expectations, 2.9%. It came in at, and there were also big historical revisions. If we think about it, then more excess demand, that implies more inflationary pressures, and so the need for more rate hikes. But again, similar to the RBA, as we've said, cumulative hikes in Canada, 3.5% now. So 350 basis points of tightening since I think May only. So the bank may kind of want to see evidence of a slowdown. Certainly that is being seen in the housing market. Also, there's high household debt levels. So that may be a concern, may be something on the Bank of Canada's radar. So we'll see whether they hike 25 or 50 is firstly key to look out for, and then any guidance from the bank as to how close we are to the top of the hiking cycle, whether we are actually at the end of it. That will certainly determine price action going forward for the Canadian dollar. Of course, the risk-off mood and oil prices are sort of major drivers, long-term drivers, if you like, of the Loonie. But certainly near term, yes, what the bank says about the policy outlook will be critical. Kind of a hawkish outlook, hinting at more rate hikes to come, even if, say, they only do 25 basis points. That might support the Canadian dollar. But then in contrast, if we have a bigger hike, but then a more neutral outlook, kind of saying that the bank will stand aside, potentially then that sees the Loonie sell off and has a bigger impact really on dollar CAD then. So just looking at that chart, actually, we can see sort of the grind higher from the November lows with support holding around 132.23 there, and we sort of pushed slightly higher. You can see yesterday we broke above that trend line resistance from the October high there. So interesting then we get up to a sort of minor fib level at 136.82. That's the fib level from this August rally actually. So potentially, yeah, resistance at 136.82, but really interesting that we have broken potentially that trend line resistance, which now becomes trend line support around the 50-day moving average at 135.68 in dollar CAD. So near-term driver, of course, Bank of Canada meeting in a couple of hours, and then obviously looking out generally for risk sentiment and oil prices as well, being a drag on the Canadian dollar. Okay, I think that's all we've got time for today. Covered a lot of areas, of course. Only have this webinar 2 weeks, so hopefully you've gained some knowledge from it, and we look forward to speaking to you again in a couple of weeks' time. Okay, take care.